Welcome to Changing World, New Opportunities. This podcast is brought to you by the DC Investment Forum and hosted by me, Louise Farrand, and my co-host, Dave Whitehair.
This season, we're talking to the UK's leading master trusts. Millions of members and people in the UK now rely on master trusts for the future of their retirement finances. And we were interested to know how master trusts are investing and what the future holds.
In an uncertain world, how are they managing risk? And what's next on their agendas?
The DCIF's mission as a whole is to shine a spotlight on topical DC investment issues. And you can learn more about our research, follow us on LinkedIn, and subscribe to the show at dcif.co.uk.
Welcome to Season 4 of Changing World, New Opportunities, this time brought to you on video. Today we are speaking to Veronica Humble. Veronica is the Chief Investment Officer at NatWest Cushon, and she's been in her role since March 2024. Great to have you with us, Veronica.
Thank you.
In an interview recently, Veronica said, "I want us to be remembered as the first generation who actually built a sustainable society. And I think pensions as long-term capital, as slow money, have a very big role to play." So I'm really interested in hearing more about the role she envisages NatWest Cushon having in that transition.
Yeah, likewise, I think NatWest Cushon have been one of the disruptors in the UK master trust market, and they place investment and particularly sustainability at the heart of their proposition. So I'm really looking forward to diving into those areas with Veronica.
Veronica, tell us a little bit about your career path to date and your role at NatWest Cushon.
First of all, thank you for having me. This
Thank
is
you.
A pleasure. So I'm also looking forward to this recording. And I have been in pensions investments for actually almost 18 years now. But I gradually transitioned into DC and sort of semi-accidentally when George Osborne announced that nobody needs to buy annuities anymore. Suddenly the interest peaked on DC.
Yeah.
And one thing led to another. But I totally fell in love with this. Not just because it's an interesting thing from the investment point of view, but because it's so intrinsically linked to the members' outcomes.
Yeah.
And not just from the purely investment point of view, but how we explain to members what we're doing, what they feel about their investments, what they feel about their financial future, and what we can do as investors for them in terms of building that world that they will retire into. Mm-hmm. And that's where I think the pension slow money is coming from as well, because it's not about the next couple of years. It's not about 3 to 5 year time horizon. It is for some members,
sure,
but fundamentally this is 10, 20, 30 year horizon for the majority of our members. And that's what we need to remember as well.
Yeah, definitely.
So before we dive into some of the detail, can you give us a bit of a helicopter overview of your investment strategy at NatWest Cushon?
So we have a diversified investment strategy. In the growth phase, we have 75% in global equities, 15% in private markets, which is, again, a very important part for us. And I'll come back to that later. And 10% in bonds, which are all diversified bond strategies, but with a very specific impact focus. And Lombard Odier's strategy is one of them. From the private markets perspective, this was always again a focus for us. We actually seeded UK's first LTAF, but we are building on top of that as well. So our main strategy there is very climate focused. So a lot in renewable infrastructure, private equity, but also diversifying with time. So we recently allocated to natural capital as well, but it is a fairly small allocation, but a meaningful one. So we're looking forward to actually deploying the assets there. And we are currently also looking at VC allocation and working towards allocating hopefully later in the year. But as you know, with trustees, it's a long process, and we have quite a lot of steps to go through before we do that. But overall, kind of from the investment perspective, it is very climate climate focused, but we see climate there not as a specific feature, but it's an investment risk and an opportunities point, because like whatever we do in climate have moved from being kind of something for 2050 to actually what's happening now. And I think we looked at this a couple of years ago, but we are evolving strategy there as well to account for kind of our new thinking and what's happening in the market.
Oh,
how does your
loads about that.
How does your broad asset allocation change as members approach retirement? Does it change dramatically from your growth phase investing in terms of the allocations to equities, fixed income?
Yeah, no,
private
obviously
assets?
kind of the allocation to equity decreases. We increase allocation to fixed income, but this is something that we will also be considering next year and part of the next evolution. But it is a fairly standard in the market. We have a 7-year de-risking period because we think that's a sensible length, which gives people enough to prepare for, but at the same time kind of doesn't de-risk them too early, because from the investment perspective, we know that if we start too early, if we de-risk people too early, they will sit in lower risk for too long, and that potentially decreases the range of options and overall investment outcomes for them.
Perfect. Lots to come back to. Lots to talk about. But first, let's start by talking a bit about risk management, if that's okay with you. So obviously, there's always a huge amount going on. It always seems there's a huge amount going on when we record these podcasts. It never ends. But how have you evolved your investment governance as a result of all the volatility we've seen in recent years, if you have changed anything?
I mean, the beauty of pensions is obviously saying actually we are long term.
Yeah.
So although you need to be mindful of major shifts and ask yourself whether there is something that kind of has shifted massively that will have an immediate impact, and you have to reconsider. You are not supposed to panic. Exactly. And, we have seen that with COVID, right? That kind of massive changes in the market, bounce back and like nothing happened. And same thing with Trump's tariffs. We will see what happens longer term, but equity markets seem to be reacting as actually not much is happening, which is slightly worrying on the personal level. But nonetheless, from the investment point of view, kind of do have a better idea. However, what we're doing is we're building out the investment framework and the risk framework. So I have a fairly young, energetic team and have done a few hires recently. So we're kind of starting to just formulate our thinking there and have a framework around long-term investment risks, attitude and the way to address them, the kind of what are the risks that we need to be mindful, like on the weekly or daily basis, what are the things we need to come back to and reconsider. And particularly we are having an interesting conversation with our trustees in terms of like what are the existential sort of quote unquote risks for our strategy. And obviously kind of climate risks come to that. But there are also other things like, has something fundamentally shifted in the equity markets? And I think with a lot of these things, the normal answer should be kind of actually, no, we think that nothing kind of fundamentally has changed, but this is something that you need to kind of keep on asking yourself. So one of the things that we are discussing at the moment, as I think probably everyone else, is like, what's our hedging strategy? And sort of, because to date we had kind of unhedged global equities, but I think the market is shifting and people are doing more of the more hedged strategies and kind of explicit views on dollars. So we'll see. We have started that conversation.
Exciting.
How do you guys as an investment committee think about diversification from an investment perspective today? Obviously, we've been living in a world where there's 7 global equity stocks driving huge proportions of kind of risk and return. people that have invested a lot of time and effort into diversification maybe haven't seen the benefits of that over recent years. How are you guys thinking about this topic?
So our equity strategy is the global equity. So we have tilts, but they are climates and SDG aligned tilts. We don't have kind of factors embedded. That's a conscious decision, and for kind of from where we are at the moment, I think we are not moving away from that because kind of I do see arguments like, oh, there is too much concentration in sort of Max 7. Yes, but how did it play out for those who were thinking that 2 years ago? However, kind of that is something that, again, kind of these are investment beliefs that we need to go over regularly and reaffirm with our trustees. Yeah. Is this something that they're comfortable with? Is it something that they see shifting? And we are blessed with an incredible set of trustees as well, who are all really investment focused. So we have a very, very healthy dialogue there.
And from an investment perspective, you've alluded to, you're not just exposed to equities in the growth phase, you have other asset classes in there too. That's part of your strategic foundation. Yes,
exactly. And kind of so bonds obviously provide quite a bit of diversification there, but also growing private markets has that purpose as well. In addition to the impact and the stories that we can tell and the kind of real world changes that are coming through that, obviously there is a pure diversification argument there. And, you know, people have different views on private markets. Like, we believe they provide good returns as well, and kind of on top of the listed versions, but at the same time there is just a pure access to that part of the market argument and diversification argument. So that's why we view private market as a significantly important to our investment strategy. So we think that kind of we will probably move to higher allocation, because currently we have 15% strategic allocation. I can see that moving to 20% in the future, but that's not something that we have started at the moment yet.
Bring. Now we're on private markets. Bring your strategy to life for us. Like, what's in that 15%? What does it look like? And
so yes, the kind of 11% is our Climate Plus mandate with Schroders, and that's a diversified private markets. With a heavy tilt towards the UK, but that is primarily because there is a lot of renewable infrastructure there, and kind of private equity again linked to the renewables. But we are also building on top of that. So as I said, the natural capital which comes in, and VC in the future. So we will bring it back to 15% very soon.
See, that's really interesting and exciting. Can you say any more about that at the moment? I mean, I guess for me, the holy grail of VC is like, how do you make it diversified and invest in a way where it doesn't feel kind of super risky? Like, how are you thinking about all that as you kind of mull your first allocation?
Very good question. So I think from the members' perspective, again, if we come back to the time horizon, right, it's 10, 20, 30 years for the members. So kind of super long term is quite naturally aligned to where the members are. And also kind of from the risk perspective, you kind of, again, bring it on. One other thing that I'm generally kind of set aside the kind of details of how do you make it diversified, etc. Like, again, I'll come back to that. But just from the strategic point of view, you know, people get very twitchy about VC sometimes, but also are perfectly comfortable with global equities. So 15-20% annual volatility in the global equities mandate is fine, right? So plus minus like 30% drawdown possibly annually, that's fine. 2% allocation to VC, suddenly people get twitchy.
Yeah.
Exactly. So, you need to have a very disciplined approach. You need to know what you're doing. You need to learn kind of partially for DC, you probably need to learn by doing. But I do feel that when people look at this in isolation, that's not quite how they should work in the portfolio. And it confuses sometimes familiarity with risk. So we understand global equity. So it's fine if they drop 30%. If we if there is some drawdown in the VC portfolio, no, that's not possible. And I think that it's the UK does have sometimes a much more risk-averse attitude as well. We can't possibly lose money. It's like, well, unfortunately, in private equity, in VC, you will lose money.
Yeah.
It's fine.
It's part of investing.
It's part of investing. It's just that you need to have a diversified enough portfolio, and you need to get the right companies in so that you overall, it will make sense and will make the good returns.
How are you tackling some of those views and nervousness around asset classes like VC?
So I think some of that is just working with the managers, and we're working with the two potential VC managers, including the British Business Bank. So obviously they have a good pedigree in the UK. They have a a really good set of connections in the UK. So, it's through familiarity for trustees as well, and we're working with them to create that mandate. So they have been in that space for over 10 years. To a degree, it will still require a leap of faith because we do not have in the UK, we do not have 30 years of Silicon Valley experience. But at the same time, we have great opportunities. And again, from the investment point of view, we are building a diversified portfolio, but I'm fairly comfortable with certain allocations, for example, being heavier in the UK than the others, particularly given that our global equity mandate doesn't have UK bias here.
Yeah. And how are you accessing private markets at the moment? Is it through LTAFs or directly?
So we have the LTAF for the main allocation with Schroders, but we started building having satellite allocations on top of that. So in time, I see that evolving, but for the time being, I think that's a good model for a lot of people as well in the market. So you have the core allocation within a diversified LTAF, and if you want to add things on top, that makes sense.
You've referenced the UK and investing in the UK a few times so far. Do we infer from that you're a signatory to the Mansion House Accord?
Yes, absolutely. And we have been supportive for a while. So we are also signed to Mansion House Compact. We see that as a natural evolution and are thrilled to be part of that.
And are you putting more effort into communicating what you're doing in the UK for your members so they can see?
Oh, absolutely.
Yes.
Again, we are a fintech company by our background. And as you said, we do view ourselves as a disruptor in the master trust market as well. So we do communicate with members primarily through the app, and we surface the stories of the real investments that we're making. We have a map of the UK, so where our investments are primarily through our private markets allocation, and you can literally see here is where here is your nearest one.
Oh, wow. And you track the engagement of this. What does that look like?
So we're looking at that, and we're definitely seeing that resonates a lot. Storytelling is, I think, underused in DC as well. We're all talking about how we need to engage with members, not because we just want to talk to them. Obviously, we do want to talk to our members, but at the same time, when they are familiar with their investments, when they're familiar with their pensions, it means that they probably can consolidate their pensions there. They probably feel better about what they're doing with pensions contributions and overall with savings, it builds overall financial resilience and improves financial confidence.
Yeah.
Yes. We actually have some research in terms of the tracking where we looked at engagements sort of with our app before generally and before members increase their contributions, and you can see it's kind of building out. And then kind of the increased contribution, it still remains higher than the baseline. So we're seeing that as well.
Amazing. And talk to us a little bit about private markets in the kind of later stages of someone's savings journey and perhaps once they've retired. Like, do you think private markets have a place at that point, or do you see them more in accumulation?
Yes, I think that kind of we haven't done that much work there yet, but kind of that's basically you're front running our strategy for the next year. So we are looking at that, and kind of definitely there is the private credit will play a role there. So and there are good rationale for seeing private markets within the retirement portfolio as well, because fundamentally people are super comfortable with in their personal life in investing in illiquid assets like property and seeing the income from property as an integral part of their retirement portportfolio. So there is absolutely nothing new from that perspective, but it is a much more
steady,
stable income.
Yeah. So what needs to change, do you think, if anything, to make that element easier in terms of using private markets into retirement? I guess one thing that people sometimes worry about is the liquidity issue.
I think the liquidity issue is a bit overblown. Because particularly in the next sort of 10, 15 years in DC, it's still super kind of contribution positive. So, and as people move along
the sort of retirement curve.
Exactly. So kind of more people come in earlier. So, you know, even if you have private markets, it's not like they have this slice individually. When they're selling out of that, other people are buying. So I kind of find this argument a little bit mystifying, because this is already happening in any of the pooled funds. So unless you are you have a very mature population, it's not a problem for the next like 10 years at least. Definitely not an issue for us. However, also if you're thinking about retirement, if you're looking at the more kind of yield focused portfolios, that is also naturally happening. Obviously we'll have a place to play. There are still kind of regulatory questions around percentage that you can hold in LTAFs and all of that. But yes, we will be working through all of that. And obviously kind of it's a continuous dialogue with the regulators and with the government.
So moving on now to, I know, an important topic for NatWest Cushon, that of sustainability and specifically climate investment. Where are you on your journey aligned to kind of net zero targets, and how are you measuring your progress?
In terms of our thinking on sustainability, we're primarily focused on climate, because we see that as both kind of the biggest risks and the biggest opportunities, and not just long term, but also it is happening now. We do see that obviously there are kind of already events that are kind of, wildfires and kind of risk events, which have moved actually for all the fund managers as well that we're talking to. This moved from being something kind of 2050 to actually how does it affect portfolios now? So we have a framework of kind of three elements for our climate approach, and it is portfolio decarbonisation, real world decarbonisation, and portfolio resilience. And if the whole industry thought that portfolio decarbonisation is like the silver bullet, we've done it, sold out of hard to decarbonise assets, and hooray, which kind of doesn't quite fix the world.
Yeah.
This is why we view that real world decarbonisation, particularly through private markets and providing new capital to the projects, is super important. In addition to the fact that we also can measure impact, we can show the impact and show the assets to our members. And then portfolio resilience is something that we see coming up more and more, both kind of longer term and shorter term. And some of that is purely climate, some of that is just wider. We do see also adaptation playing kind of more active role there.
Right.
Frankly, we are no longer in a 1.5 degrees world.
Yeah.
And it's like, it is what it is. And it's interesting how the conversation has evolved, and how, for example, in emerging markets, it is all about adaptation. Whereas I think some of the developed countries are still slightly hiding their head in the sand, thinking it's like, no, we'll just magically transition very smoothly.
Yeah.
So this kind of more potential disorderly scenarios or delayed scenarios is something that we're looking at. We're working with Transition Exeter, which is a spin-off from University of Exeter, talking about venture capital and startups. And they're doing some really, really interesting work with measuring transition and physical risks. And we have a joint project with USS on that. And that includes also different climate scenarios.
And is this work and the framework and it's part of this context behind your recent natural capital allocation?
Yes, because that provides some kind of high level hedging against carbon prices, but also kind of as natural capital, as physical assets. The adaptation bit plays a role there.
Yeah.
One thing we were talking earlier about is, you as one pension scheme, obviously, you have lots of assets and you're a significant player, but there's sometimes this frustration that you're only one player, and while you're doing one thing and you're behaving responsibly, you're sort of one player in this very big system. How do you think we kind of change the dial more systemically? And is there anything that we as pension schemes should be doing to kind of play a role in that kind of global discourse around moving to net zero?
I think UK pensions are great. We're all collaborating on this. So, and in a way, it's not a competition at all. It's kind of the more the merrier. From our perspective, it is working together with other schemes. We're working with Transition Exeter, a spin-off from University of Exeter, who are doing some really, really interesting work on measuring, quantifying the transition and physical risks in the portfolio. And it's engaging with regulators because kind of as a single scheme, we obviously can't move the dial, but actually policy engagement does help.
And you mentioned the word regulator there. It's a nice segue into the next section of the podcast to ask you around how big regulatory shifts are influencing your investment decisions and your kind of corporate policy. The best example is probably the pensions bill, which has recently come out. Can you talk to us a bit about regulatory environment and the impact that's having on you from an investment perspective?
So we're very supportive. I think that kind of both the scale requirements and generally kind of pretty much all the elements there are very sensible. Like, I would say that, wouldn't I? For various reasons. But at the same time, I think this is kind of, it's providing clarity of where the government sees the pensions industry in a few years' time, and it's helpful.
Yeah.
We can start planning, and I think it will create bigger players who will then will be able to move the dial more. Yeah. I do worry in terms of potentially creating some interesting dynamics in the market where people just sort of wait and see where it all comes out. But at the same time, this is not something that we can influence from our side. So yeah, we're supportive. I think that Mansion House Accord is a really good initiative, and it's really interesting to see how the market is evolving. And one other thing that I just keep on highlighting is that we understand the impatience from the government, for example, and kind of from other players. But at the same time, we have actually, as a pensions industry, we have moved a lot.
Yes.
If you think about kind of where our conversations were 5 years ago, it was like, whoa. It's like for pensions, we're moving like lightning speed. Like we have seeded UK's first LTAF sort of 2.5 years ago. 5 years ago, that would have been almost unthinkable. Yeah. And now everyone is very comfortable. So kind of, do I think that, for example, LTAFs are a silver bullet that will solve pensions problems with private markets? No. However, it provided an incredibly useful stepping stone. What we're seeing, for example, is everyone's got now their LTAFs. And then it turns out that people are now comfortable with private markets, or much more comfortable with private markets. So they're thinking, what goes outside of the LTAF, or sort of how they evolve their LTAFs. Yeah. So suddenly we're in a totally different conversation. We are not talking about whether it makes sense or not. We're discussing the details. And I think with a lot of other things, this is where it ends up. We're starting with like very conceptual. It's like, oh, should we, shouldn't we? And then a year down the line, we're actually discussing the implementation. And then another year down the line, we're actually doing it.
Yeah, and I'm sure you're learning as you go along. Like you're new investors in many of these asset classes, and you're learning as you go, and your governance is improving as a result of that. Can you talk to us about?
Absolutely, yes. And kind of we have a very, very collaborative relationship with our trustees. They're all very, very investment focused, so they provide both challenge but also direction. We are all learning. We're all learning together with trustees, together with our investment consultants. So it's a really good collaborative relationship. And it's interesting to see how, yes, it's a bit of a nervousness around kind of how we do the first step. And then once we've done it, kind of the next things are much more comfortable. So from the governance perspective, again, like obviously, so we are as an investment team, we provide our not even recommendations, I can't say recommendation. We provide our proposal to trustees, who are then, as asset owners, take their decisions with their investment advice. They do challenge us. They do challenge investment consultants. So we have seen them actually saying no to us, saying no to their investment consultants. And I think that's where we all should be as an industry as well, where kind of it's a healthy three-way relationship. So we are building governance and investment governance in particular from our side. We're building investment risk framework, both on the listed side and on the private market side. It's about building your internal capabilities, using external capabilities where you can, and having a roadmap.
Exciting. So let's talk a little bit more as we come to the end of our chat about that roadmap in the next 5 years, or next kind of future-looking agenda anyway. So one of the questions we're going to ask everyone, what's one investment trend or technology you think will play a role in reshaping DC in the next 5 years? I know it's hard to peer into your crystal ball, but can you humour us for a minute?
Yeah, a very, very good question. So, I mean, like, we can't possibly avoid the AI question, right? I think that will be both from kind of everything around it, but kind of all the research, and we're obviously using it all. But also, if we think about how relationship with members will evolve, that will play a big role. So from our investment point of view, I think further private markets investments, where again AI will play a very big role, because because I'm kind of personally very bullish on how it develops, and kind of seeing all the venture capital world as well. Kind of so much focus there is on not kind of high level AI. It's much more implementations, all the smaller companies that are kind of, it's just much easier to start the companies, to start your ideas, and to kind of then move much quicker. I think we will see a lot of that. And we see all the headlines around the sort of implementation in the NHS. And I'm really thrilled. And kind of, I think this is where we both can see that in our portfolios. It will be thrilling to explain it to our members and to sort of to show them the impact and kind of to see the whole market evolve.
That's exciting.
And you've alluded to VC already in terms of maybe something you'll be looking at next. Are there any other investment areas on your agenda?
I think this is just reviewing our strategy overall as normal, as everyone does every year, and kind of evolving our private markets allocation, including VC short term, but also longer term kind of private credit and diversifying it more.
Is there any asset class or theme you think is particularly kind of underrated right now?
Good question. No, I actually don't think it is. I think there are generally, it's well diversified, and I can't.
Already some interesting themes without us kind of trying to pick through.
I think there are too many interesting things. If anything, there is not enough time. And I think kind of that's one of the things that AI is doing, is obviously accelerating all of that. And so, yes, I don't think that there are any totally forgotten themes where just everything gets accelerated.
Yeah, perfect. And I think final question from me is how consolidation is affecting your investment agenda, if at all. I guess, how is it playing into the way that you're invested, if at all, that kind of feeling that master trusts existentially are all changing? How do you think that will play into how you invest, if at all?
So currently, not really.
Yeah.
So what we're hearing in the market as well is, because everyone is looking at more or less the same things.
Yeah.
We will see things merging, and we see people looking at the same ideas, at the same strategy. So I think this is not something that will stop investments. It's much more kind of, we're all exchanging ideas and we're all talking to the same fund managers. It's thrilling.
How exciting.
Brilliant.
Anything else from you?
No, that's been really interesting. I'm looking forward to kind of following the journey of NatWest Cushon and others over the next few years, because we've come so far in a short space of time, and I still think there's some really exciting things to come. So it's been a really interesting conversation.
Thank you, Veronica.
Thank you for having me.
Thank you for listening to Changing World, New Opportunities, the DCIF's podcast.
Visit us online at dcif.co.uk, where you can read all our research, follow us on LinkedIn, and subscribe to the show.